Welcome back to Who's Up, where we get into finances, we cover some current events, we talk about sports, and we get into health and wellness. So, Justin, what do you have for us today with the finance game?
Today we are going to talk about the purchasing of a house. Um, all of us are homeowners, so we're going to kind of talk about some of the things maybe that we learned while purchasing a home and some of the things that we would do differently if we were to buy our next home, as well as kind of some other things in between. So the first thing that I'll start by saying is like, when you go to buy a home, what are some of the first things you need? Number one, you need to know what your credit score is. You don't want to go in there, get a pre-approval. They take a couple points off your score and they say, congratulations, Mr. Danny Ocean, you have a 525. And so now you got about a 522 because they did took some points off there. So that's another thing. Also, if you are a W-2 employee, they want you to have 2 years of bank statements. Um, if you're a business owner and you're a LLC business owner, meaning they're able to kind of track back like, okay, we have 2 years of your business filing taxes so we can see your income, your bank statements and stuff like that. And you don't want to have that under the mattress money. Like that money's cool and all, but they can't account for it. So you need to at least make sure if you plan to get pre-approved in August, you need to have that money in your account for at least 60 days. So go ahead, pull the money out, let them see that it's been in there for 60 days. The next thing you want to do is interview a real estate agent. Don't, because that is the most important part of your entire journey. You could have all the pre-approvals, you can be qualified to purchase whatever kind of house you want, but if you ain't got nobody fighting in your corner, especially if it's your first time, you don't know if like, oh, okay, I in a good area? Am I living in a good area? And is my property expected to appreciate? What are the schools like? A lot of that information you can most likely find on your own, but we paying her 3%. Come on, you saying help me out. Let me get my money's worth. So I'll start by saying some of the things for me that I learned through mine is how important a real estate agent is. You need to make sure that they are very, very knowledgeable, especially in my case when I was looking at it more as an investment. And so I think some of my biggest takeaways is you're the CEO when you're buying a house, meaning you got the loan originator, he or she works for you, the realtor works for you, the what do you call it? The underwriter, they work for you, and the particular bank that they work for you. So you need to make sure that you understand what's a point. And if you aren't, and if some of our audience doesn't understand what a point is, it is a percentage of the loan that the loan loan gosh, loan originator or whoever you have your loan through that they charge you. So for example, if you have a $100,000 loan and they charge you 1 point, it's $1,000. And so that's on top of what you have to pay for closing costs. And depending upon whether you live in DC, Virginia, Maryland, whatever, your closing costs may be 3 to 3.5% a year. So if you're like, hey, I want to buy a house, make sure that you have enough money for the down payment, which is depending on the type of loan you use. It could be zero, it could be 3.5, it could be 5%, or it could be 20%. So you need to make sure you have that plus your money to close. And so what are the things? My biggest takeaways from buying a house is do not rush the inspector. Whether you that I want to say that I don't want to say little $500 because $500 is a lot of money, or depending on however much your inspection charges, don't rush them. I think that's one of the biggest mistakes that I made is I assumed that, oh, he taking too long. Come on, hurry up, bro. Like I'm gonna close on the house unless you tell me the foundation about to crumble. And again, I wish that I would have gave him a bit more time to really go through and fine tooth comb this house, because that's your whole livelihood that you got sitting on, on a piece of property. So you want to make sure that that you get that doctor checkup on the crib. and what else would I say is to always have reserves. So as we all know, as homeowners, you think you bought this nice, shiny, or depending on what stage you bought the house in, you're assuming that it's going to be ready to go. And so you never know what's going to be behind, once you start removing wallpaper and paint and what was, kind of duct taped and glued up there. So you need to always have some money so that you're able to kind of pay for some of the repairs. TJ, you got anything else you want to add to that?
To add to that, I would say going back to like the loan process, kind of know what type of loan you want before you actually start looking for your house, because that also determines how much house you can afford. If you want to do a zero money down loan, you know your interest rate's going to be probably a little bit higher versus paying 20%. You won't have to pay your what's that insurance that you have to pay if you pay less
Mortgage insurance.
yeah, the mortgage insurance.
Yeah.
So little things like that will affect your monthly payment, which ultimately determine what type of house how much you can buy. One of my biggest tips, I know for me, I will tell anybody never to buy a move-in ready house because you're paying for somebody else's hard work, sweat and tears. Other than that, Justin, you hit the ball on the nail, but I feel like you can do little things. Even if you hire somebody it's a lot cheaper to hire somebody to come in and paint your house, do carpet, update the appliances and stuff than paying twice for it when you buying a move-in ready house. I mean, like I said, they're hard to find non-moving ready houses because obviously people want to sell them, so they will do those things to help bring up their profit value so they can sell it for more. So knowing that, you can get a better, more house for less money if it needs a little work.
Yeah. And just one thing to kind of piggyback off when you're talking about the different interest rates, and they are such a huge deal. And so to kind of delve a little further into the interest rates and the type of loans is, for example, an FHA loan, which is a loan that's backed by the government, right? So they tell you, oh, put 3.5% down. And a lot of people are like, oh, that's fantastic. I only got to put 3.5% down. But you don't realize that with FHA loans, there are a lot of other fees that are jam-packed into that loan. So for example, with me, with my wife and myself, when we went to purchase our home, we were going the FHA route because we're like, okay, we can get a bigger home, only have to put 3.5% down, and we'd be straight. But my loan officer would tell me, he said, actually, you're paying $10,000 in FHA fees. If you got an extra 10,000, just go ahead and put that down on a conventional loan. And it was, again, it was an additional 1.5% to make it 5% to be a conventional loan, right? And so you have to know what your goal is. If you just buying a house for the sheer sake of, oh, this is going to be a house that I'm gonna raise my family in, like, I'm in a position where I want to just put 3.5% down because I want to be able to close and maybe have a little bit of extra money. That may be the route that you go. But as for my wife and ourselves, we're investors. So I said, okay, so if I don't get the FHA, then I get to have a little extra money in my pocket and not pay as much in fees. But if I get the conventional, then I can use the FHA again. So, and allow me to break that down a little bit further is, the FHA, you can only have one FHA loan at one time, right? But if you did have a second FHA loan, you have to be about 100 miles from where you currently are. So maybe have one in Blacksburg and then have another one in Richmond. You know what I mean? Like the underwriter, you may be able to get away with that. But in FHA, you have principal mortgage insurance for the life of the loan, like until you refinance out of it. And so once you hit that 20% equity stake in your home, you can refinance out of it into a conventional. And so, but with my wife and myself, like once we hit that 20%, there's no need to refinance. We can also, another thing that you want to do is once you hit that 20%, let them know, because they ain't gonna just be like, oh, it's okay. You can stop paying the principal, property mortgage insurance. We'll give you that back when we do an escrow analysis. No. Y'all need to kind of watch that. And so, but again, there are different loan types where 0%, like that's a VA loan, or if you're living in an agricultural or like rural area, it's called a USDA loan. And so you just really kind of have to be sure that you understand, like TJ said, you got to understand what type of loan you're in, and also kind of where, like what your plan is, what your goal is. Because a lot of times people, the same way in a car note, you say, all I want to pay is $465. Oh, they can get you that. You paying for 96 months, but they'll get you your 465. So you got to make sure that you're the CEO of your journey, of your housing journey.
Can I chime in for a second?
Yeah.
Since I don't get to talk about financial stuff a lot. I know a big trick that happens to people is when they go to get how much home they can afford, they hear the number and it's like, oh, I can afford $1 million house. Like, no, you cannot. Like, they take your financials as if you have no bills to pay. So I know that's what kind of caused the housing bubble. You know, back in 07, people were buying homes that they couldn't afford. And then when the bill came due, you couldn't afford it. And then the bubble burst. So that's also something major.
Yeah, they were but they were also tricking people back in 08. They were letting people who worked at McDonald's buy $400,000 and $500,000 homes, knowing good and well with adjusted rate mortgages. And so they say, oh, okay, Matt, we're gonna lock you, whoever you choose to be, lock you in at that 2.875 rate. And then 5 years from now, they said 15%. Right. And you be like, no, I ain't got the 15%. They was like, no, but you signed right here that you was gonna be okay with that. And so the government had to go back and bail out those banks, because that would have caused an even worse crash than what we had already experienced in 08. And that's not going to happen again, because they require so many more details and stuff like that. Go ahead, Dr. J.
Is that kind of the same thing they did with the student loans? Let people get a loan that they really couldn't afford just because they were being predatory?
No, I think that with student loans, I think that that's just the nature of our economy, where they'll give you and I $150,000 loan to go to school, but they won't give us $150,000 to start a business. I think that that's just kind of how our world works, where they want us to continue to be employees, not employers. And also that student loan interest is what's keeping a lot of things afloat. And so I don't really consider student loans predatory, because you have a choice to or not to go to school. And they're not saying that's the only way that you can be employed. But yeah, it's a little bit different.
I got one more thing to say. Also, like me going like to buying your home and stuff like that. I know you hit on like your realtor works for you. I think that's another key point, because you know some of the realtors have they have to follow a code and stuff as well. So they can't openly tell you, hey, this is a bad neighborhood, but they can tell you, hey, the crime rate is this. But you also have to ask those questions and stuff like that. So I think just knowing those facts and doing a lot of research on your own will help you make those decisions.
And to go back, go ahead, Justin, my bad.
And I was going to say, for sure, you have to truly let them know what your plan is, what your goal is. They can't read your mind. You know what I'm saying? So like, you have to say like, all right, hey, I plan on raising a family. I want to be in an area where the school district is good. I want to be in an area where there are a lot of kids in the neighborhood. Like, I want to be in an area where there's a lot of walking tracks where, you know, I can walk my newborn baby around. Like, you kind of have to be diligent and be expressive about the things that you want. And so you also kind of have to understand the relationship between your lender and your realtor. They work for you, and sometimes they're supposed to be funneling all this information to you and also kind of reducing some of your stress. But it truly all depends on how, what do you call it? How involved you are in the process. There were sleepless nights because I'm like, oh, we need to close on this date. Oh, they underestimated my property taxes. Now I have to pay this. And so that's another thing that you kind of have to be aware of. You know, to kind of give you an example of my situation in DC, when you buy a home that was previously owned by a flipper it's called non-occupied. So it would technically be a vacant home. And so when you buy a vacant home, you have to pay 5% of the tax assessed value, right? So if the house is 100,000, your property taxes a year is 5,000. So now multiply that by 5, 6, depending on how much you pay for a house. So I didn't realize that information until after I got in there. So my wife and I were paying $1,400 a month of property taxes. And so in DC, you got to prove to them that you're actually living in a home. You got to have 2 months of electricity bills, gas bills. Like, you need to show them that you're living in there. And then they actually reduced ours to 0.85 because it's called like a homestead deduction, where they actually write off about, gosh, I can't remember the number, but it's tens of thousands of dollars that they write off for your tax assessed value. So it's a lot of things that you kind of got to learn depending upon your market. Yes, Mr. Danny Ocean.
So in DC, can you not roll that property tax into escrow, or?
You have to pay that property. You have to pay 6 months of property tax.
Okay, I got
in escrow. But again, little thing that benefited us is the sellers had to pay 6 months. They had to pay 3 months of escrow, as well as my wife and I, at that 5%. Once I fixed the 5%, there was a lot of money left under our tax bill. My wife and I will be paying taxes for about 1.5 years.
Gotcha.
So, but and also another thing is, do you all know the difference between commercial and residential?
Let's learn.
Oh, you know, Dr. J?
No.
So
refresh me. I might have misinformation.
Okay, so commercial would be considered a Walmart,
Okay.
a restaurant. Residential is anything that's below 4 units. And when I say our houses are residential, you start to get into commercial when you have more than 4 units. So technically, you, Danny Ocean, TJ, could buy a small apartment building that has 4 units and is still considered residential. And so, meaning the difference of having to put 3.5 or 5% down, or having to buy a Walmart or a restaurant and having to put 20% down. So you see that huge difference. So you can become a real estate investor by buying a 4-unit property. Let's say it's 100,000. You only had to put $3,500 down, and now you own 3 units. Now you own 4 units. But if it was 1 more unit, you'd have to pay 20% down. So instead of 3,500, you have to pay 20,000 just for 1 extra one. And so that's a lot of information that a lot of people really aren't aware of. And so again, if I had to do it all over, I wouldn't have, but just my real estate mind thinking, I'd have told my wife to buy a 4-unit. I'd have bought a 4-unit single before we was married. And then once we get married, then I would have been like, all right, let's buy a 4-unit together. Now we own 12 properties. Now we own 12 doors.
Now, one thing about that, I'm going to cut you off, but I feel like, I don't want to call it a lie, but it especially like on social media, like you make it sound so easy, but you have 12 units, you have to maintain 12 units for 12 different people, and that's going to be a lot more than 3,500. So I know we talk about real estate, but sometimes I think we make it sound like it's too easy. Oh, 3,500, you buy 4 units and then you'll be rich. Like, no, dog. Like, it's going to be, you got to make sure those units are, you got to maintain them. And like, it's a lot more work than just going to the bank and dropping 3,500 and being
yeah, for sure. I got one tenant now, and I said she a whole lot of work. They both, her since they gave him gray hair.
But he loves you because you're his tenant.
I do. Please stay. I know you got to leave. You want to leave? Please stay.
Yeah.
But yeah, no, but you're correct. But it's kind of all about like having that knowledge. Like
Right.
again, you could hire a property manager company. So for again, real estate, we talk about numbers. Let's say you got the 4 unit, and we'll just make the numbers each. It's $1,000 each, right? You rent it. Okay, no, not for 100,000. We ain't gonna even do that. 500 for 100,000. Each unit is rented for $500, right? So that means grand total you would make $2,000 a month, right?
Right.
And so 2,000 a month times 12 is 24,000, right? Let's just say a third of that, almost $8,000, right? Will go to maintenance. Would be all right. So in case water line break, you gotta replace the roof. Like you put different fund categories and say, all right, we're gonna throw a third of that in there this month just in case the roof decided to poop out in 10 years. And then if you want to say, you know what, I want to be totally hands off, pay a property management company 10%. Is that cutting away at your profits? Yeah, sure it is. But at the end of the year, you're gonna be able to write a lot of that off. And again, you hire a property management company, you say, hey, when something break, I'm pretty sure y'all got connections. Y'all, how to get the waterman, get the roofer, get all these people. Tell me what the bill is. Y'all pay it, and we keep it moving. So again, like, yeah, no, it's not easy. I didn't have so many things I had to fix in this house, and you got to figure it out. But it's also a way for you to kind of to offset expenses and to not really be living paycheck to paycheck. We're worried about like if your boss fired you, it's like, oh, it's okay, I get $1,500 a month without me having to do nothing. So I like it.
Yeah, man. Real estate is definitely something to think about. I mean, like I say, it's a lot of work. It can be really rewardful, but it's to each his own, you know. How hard you want to work for it and how hard you don't want to work for it. But that's a personal thing, and we all have our different levels of expertise when it comes to hands-on doing it yourself and stuff like that.
Just go ahead and say that you paint. Go ahead and drop that you painted a car the other weekend. It's on the tip of your tongue. It's right there. Like, we can see it. Just go ahead and flex. It's there.
Look,
go ahead. We here. Go ahead and talk about it.
I'm one of those people who, if I can do it, I'm gonna do it, and if I can't do it, I'm gonna break it. So to make sure I couldn't do it. So, yeah.
He get his money worth out the contract. Whoever gotta come over to fix it. Oh yeah, I broke it bad.
I took a sledgehammer to that joint.
Yeah, I need a replacement, not a fix.
Yeah.
All right, but anyway, that was some great conversation. So please follow us on Instagram at Who's Up _podcast. Catch this show and some of our older shows on YouTube. If you have any questions, any ideas, anything you want to hear us talk about, discuss, please email us at 1-800-WHO'S UP@gmail.com. Thank y'all. Have a great night.
All right.